Hi everyone, my name is Aaron Basil, and this is a Wall Street from Main Street guest post via Carnivore Trades. First of all, a little bit about myself. I'm a technical swing trader, very active in the equity markets, although I do follow macroeconomics and I do try to combine fundamentals with technicals in my longer term trading strategy. So this is a guest post. I've known Jason for quite some time, and he was nice enough to let me come on and talk a little bit of charts here. And if you guys like this, well, we'll make this a bit of a regular thing where maybe once a week I go over some of the charts that I think are important and just give a little quick, brief weekly wrap up. So starting off here, we're just going to look at the S&P 500. Um, and really nothing wrong with the chart, technically. We're in an uptrend, a little bit overbought short term. The problems I'm seeing here are on the larger time frames, and this is a mistake that a lot of traders make when they don't look at the bigger time frames. What I mean by that is the monthly chart. You're going to see the monthly chart of the SPY here. You're already parabolic. In fact, if we go back even further and we look back to the dot-com bubble or the 2006, 2007 bubbles, people think that we were overbought here or, it was extended here. This is nothing compared to where we are now. And these types of parabolic charts always end the same way. You can look at silver in 2011, gold in 1980, Bitcoin in 2017. When these charts go parabolic, it's telling you that this is a blow off top. We're getting ready to put in a major top. And it's not just the S&P. I mean, you look at the Dow transports here, parabolic, XLF, financials, parabolic, home builders, parabolic. Everything's parabolic right now. This is how markets put in major tops. And it's why I think that volatility is potentially going to be one of the biggest trades this year. Specifically, the fact that leverage short vol is the most crowded trade on Wall Street right now. And you look at charts like GME, GameStop, these short squeezes are really nothing compared to what can happen to the VIX. VIX can blow up in a major way. Now, before I get into more of that, just want to take a look at Bitcoin because Bitcoin is a market leader and it's really been the trade of the year so far. So we're going to switch over to that real quick. Okay, so looking over at Bitcoin now, why I think this is important is Bitcoin is the leader. It has been the trade of the year so far. Now that we have broken through 50,000, we officially have a lower low for the first time since really last year. You put in the low in March, and then you have the higher low, higher low, higher low, higher low, higher low, and now you finally have a lower low, which makes Bitcoin vulnerable to a correction. That doesn't mean I'm saying it's going to crash tomorrow, but it now is vulnerable to a correction. It's now running out of steam. And why this is important is that if money is flowing out of the market leader, then that will trickle down into the rest of the market. So as far as price targets on the downside, I think we can go as low as the low 20s. We may even go down and tag this lower trend line. And if that seems like a ridiculous price target to you, just think Bitcoin, it's not really unusual for Bitcoin to have 60, 70, 80% drawdowns. What I'm calling for is actually kind of routine here. And honestly, I don't like Bitcoin at all until it gets into the low 20s, at least for a long-term trading opportunity. I would not accumulate at these levels, absolutely not. And what I mean by money leaving the market is, for example, over the last 5 days, the largest outflow from the NASDAQ 100 ETF QQQ took place for the largest amount since 2000. Does that mean a lot? I don't know. But, there is evidence of cracks in the armor here. Interestingly enough, this outflow is taking place right before mega cap tech reports earnings next week. So we have Apple, Microsoft, Google, the big, the trillion-dollar club is reporting earnings this week. And very interesting to see record type of outflows before that happens. Does that mean anything? Who knows? But it is something that we have to pay attention to. And speaking of tech, as far as everyone knows, it's all about yields right now. So we're just going to switch over to the TNX, look at the 10-year Treasury yield. You know, a lot of, you know, if you're bullish, you're saying, oh, well, you know, yields are stabilizing now. The water's warm, just get back into tech. It's okay. This is a buying opportunity. And really, yes, yields have stabilized. But again, looking at the bigger time frames, all it's doing is consolidating bullish. I mean, it's putting in a bull flag. You have the moving averages starting to slope up. It's going counter trend. And at some point, yields are going to try and push above 2%, and that will put a lot of pressure on tech. It's also not a surprise that tech has not led, even despite yields stabilizing over the last couple of weeks, which is another reason why I do not trust this market right now. In a bull market, you want to have the NASDAQ leading. The NASDAQ 100 has barely made new highs. It just recently did, finally. The composite has not. The Russell 2000 has not. What is making new highs is the Dow Jones. The Dow has been the leader. And to me, that is a warning sign. You do not want 30 price cap weighted stocks that pay dividends leading if you're thinking that this is going to be a bull market. A bull market, the NASDAQ should be leading or the Russell should be leading. The most risk exposed assets should be leading in a bull market. Not Coca-Cola, not Pepsi, not ConocoPhillips, not these, safe plays where you tuck money away and just put them in a retirement portfolio. The Dow leading is a warning sign. It's not a good thing. It's not a bullish sign. All right, so moving on, we're going to take a look at the VIX. I'm going to talk about leverage short volatility a little bit and why I think it's going to blow up soon. Actually, you can see right here, this is the reason why I think it's going to blow up soon. The VIX puts in these patterns, as I'm sure you're all aware, a little falling wedge and then it blows up, falling wedge and it blows up, falling wedge and it blows up. But sometimes it'll break through that falling wedge and it'll kind of put in a base. See, right here and right here puts in a base and then it blew up. Right now, we're starting to put in a little bit of a base. VIX may have actually bottomed out. And that does not mean that the market can't still make all-time highs. That's actually the divergence that you want to look for when you're trading the VIX. And just to be fully disclosed, I am long VXX common shares, and I am expecting leverage short volatility to blow up within the next couple of weeks, maybe months, especially based on this chart. If you're going to trade the VIX, it's very tricky to trade, but the key to being successful at it is to make sure you keep your average within about 20% of current price. And that usually should pay out for you. You can also play it with VXX calls if you like. I prefer just to use common shares because the implied volatility in the VXX is baked into the cake and the time decay makes it a little bit trickier to trade. But regardless, from what I'm seeing, that doesn't mean it can't go lower, but it looks like it's trying to put in a base currently. Another reason why I think it's possible that we've bottomed out is if you look at some of these other charts here, Viacom, all these charts that were, all these stocks that were involved in the Archegos and Credit Suisse mess. Look at how long, I mean, it went from $100 down to $40 in a matter of days. And this all here, this is all forced selling. Smaller funds, retail, leverage longs being forced to sell. And it's taken basically a month for Viacom just to catch a small bid. I think Viacom may have actually bottomed, but who knows? Credit Suisse says they still have exposure to some of these names. The company GSX, $90 down to $30 in a couple of days. VIP Shop, 46 to 25 in a couple of days. Discovery, almost $80 down to 35 in just 1 week. And they're on CNBC. Oh, it's just Credit Suisse. It's just Archegos. It's limited. You know what that really reminds me of is 2006. Hey, it's just subprime. You had Ben Stein and all those guys on TV. It's just limited to subprime. It's not going to be prime mortgages. Fannie Mae's fine. Let me tell you, when there's one cockroach, there's 1,000. Especially with hedge funds, they all crowd into the same trades, and that's why you have these blowups. Because they all have to run for the exit at the same time. And I guarantee you a lot more of them are exposed and it's going to come up soon. And when you look at the most crowded trade, which is leverage short volatility, that's why, I mean, when you look at this chart, if they can do that to Viacom, I mean, Viacom's been around for decades. It's like basically a Dow stock. They pay a 2.3% dividend, and that thing got blown up for 50%. Just imagine how much worse it's going to be when, you know, you have large cap stocks that have to get deleveraged. The VIX is going to be, I think, in my opinion, is going to be a highly volatile trade this year. So that is something that I am positioned for. And it's not an easy trade. I mean, if you don't have the stomach to be down 20-30% for quite some time, and you don't have discipline to average in, it's probably something you don't want to mess with. But yeah, I'm just telling you, this is what I see in the charts, and this is what I'm seeing fundamentally as well. I also want to quickly go over gold a little bit, because I know a lot of you guys are gold investors like myself. What can you say? Love the chart. Got a nice W pattern. So you come down, boom, little W bottom. A lot of the time we have what we call a WV. So you'll see, you know, get the W like this, and then you'll get a little pullback, and then that's where you get the V. So I am expecting this to move up and test 1950 at some point in the near future. And then after it gets through that, I mean, you're looking at new all-time highs here. And I loved when people were beating it down. Oh, gold is old. Gold, you want Bitcoin, crypto is the new gold, this, that. Gold hasn't done anything in 7 months. Again, bigger time frames. What's gold doing on the bigger time frame? Oh, it retested the breakout from 1700. Oh, look, just back testing this breakout, just back testing the 100 moving average. What's it doing on the monthly time frame? Oh, just a giant cup and handle retesting the 20 moving average on the monthly time frame. This is exactly what you want to see in a long-term cyclical bull market. I'm a short-term trader for the most part, but even I'm not this short. I mean, the amount of talking heads like, oh, gold is old, it's not doing anything, it's dead. I mean, it's so short-term minded. You look at the bigger time frames, and it'll tell you a much, much, much bigger story of what's going on in any equity, really. So just something I wanted to talk about there, because I know a lot of you love gold. We'll briefly cover silver too, since that's a good one. I really like this pattern here. So you had like this potential head and shoulders. You see this shoulder, head, shoulder, and then you have the breakdown, and then you close back above this neckline. That's usually a very bullish indicator. When you have a pattern like that fails, usually you get a move in the opposite direction. So I am expecting silver to test $30 at some point in the near future. Also, again, bigger time frame. Look at this chart move up, nice bullish consolidation. Silver is just working off an overbought condition, just like gold. You go overlook at gold, it had a parabolic move. It's working off an overbought condition. That's all it is. So I really love the precious metals right now. But yeah, just those are some of the charts that I'm looking at. If you guys like the video, drop a like, thumbs up, and if you guys want to follow me, you can check me out on Twitter, just at Aaron Basil. I go by Carnivore Trades on there. So yeah, once again, thanks to Jason for having me on, and hopefully we'll see you guys again next week. All right, thanks. Take care.